What do you feel where the market is going to go forward from here?
Many investors in the market are fairly new, so they have not seen what happens in the market.
So it's right time to start investing as well.
The real moves in the market often come when there is fear and uncertainty. You look at 40 years of investing and you miss out on the 10 best days. I mean, you might think, what is 10 days in 40 years? But it takes away 2/3 of your returns.
So what does historical trends show you about the current market, and what are the interpretations that you draw from the history which tells us that which way the stock market is going to go forward?
I said no if then but. This is the risk in small caps. Please get out and get into a steadier portfolio.
What explains your argument that you are asking people not to follow the investment strategy of Warren Buffett? Young investors look up to him, they read his books.
One, they may not be doing what you think they are doing. So for example, Warren Buffett, everybody thinks he buys and forgets. But no, I mean, if you look at the actual data, he sells 85% of what he buys within 2 years.
Hello and welcome. You're watching Republic TV and Republic Business. This is Rajat Mishra. Indian equity market capitalization has gone down below $4 trillion. The investors are jittery, stocks are volatile. No one knows in which direction the markets are heading. As far as there are a lot of divergent viewpoints as to where should you invest, whether you should stay put in the market. To dissect the various layers of the market, we are joined in by a very special guest, Devina Mehra, who is CMD of the First Global and who is a very well-known author who has recently come with her book, Money, Myths and Mantra, an Ultimate Investing Guide, in which she talked about the past, present and the future of the market. So we will have an enriching session with Devina. So thank you, ma'am, for joining us and speaking to Republic Media Network and Republic Business. And many congratulations for coming out with your book, Money, Myths and Mantra, an Ultimate Investing Guide. I want to begin by asking you, a lot of chatter and confusion as to what next for the Indian equity market. The market, some people are saying it's correction, it's right time to exit. Some people are saying it's right time to stay invested. So what is your take? What do you feel where the market is going to go forward from here?
Thanks for having me, Rajat. And the thing is this, that many investors in the market are fairly new, so they have not seen what happens in the market. And so what has happened is not unexpected or unprecedented or any of that by a long stretch of imagination. If you go back 18, 19 years, every single year there has been a correction. That means a fall from the top of at least 10%, barring 3 or 4 years. Right. So it happens every year, and 2023 was one year where it did not happen. So in a sense, it's after 2 years that you've seen this 12-13% drop in indices. So it's not something which is not to be expected. I mean, people in theory know that equity markets are volatile, but they think equity markets being volatile means that one year you will get a 20% return and one year you'll get a 7% return. But the next year it might be a minus 25% also. Right. So that's the nature of the market. That's the nature of the beast. So it is nothing which is strange. So that this is the first thing people should remember, that this is par for the course. Of course, there's different segments in the market and your strategy has to be different for different categories. But for market as a whole, there's nothing disastrous that has happened.
So the question that whether we should exit the markets now or should we stay invested, because some people are saying that it's right time for young investors to come because the overvalued stocks have gone down. So it's right time to start investing as well.
Sure. I mean, I would agree broadly with that definitely it's not a time to stop investing, because for that I'll just give you one background, that all of us know the risks of investing in the market, that if you invest in the market, you can lose money, but there's a risk to not being invested. To whatever extent your equity allocation is, I always say that don't put 100% of your money in equity, but whatever is your equity allocation, this is definitely the right time to be invested, provided you are in the right segments and the right kind of stocks. But definitely it's not a time to sit out in the markets, because the real moves in the market often come when there is fear and uncertainty. I'll give you one statistic why I'm saying there's risk to not being invested, that if you look at 40 years of investing and you miss out on the 10 best days, I mean, you might think, what is 10 days in 40 years? But it takes away 2/3 of your returns, as much as that. And if you miss out on the 30 best days, which is less than a day a year, 90% of your returns go out. So instead of like 100 rupees, let's say, becoming 80,000 in 40 years, it is only 8,000. Right. So there's a huge risk to not being invested. So most of the time, unless you're pretty clear there is a disaster looming, it makes sense to remain invested. But it may not be the same stocks where you are today. So with that caveat.
Okay, understood. And also, you are someone who has a strong command over the historical trends of the market. And you have extensively mentioned in your book, I was going through it. So what does historical trends show you about the current market? And what are the interpretations that you draw from the history, which tells us that which way the stock market is going to go forward?
Okay, so let's look at it in two segments. So one is the large cap mainstream indices like Nifty or Sensex and that sort of thing. So there, I mean, our impression is that Indian equity markets give you 15-16% return compounded. But what people don't realize is that there's big variation not just from year to year, but from decade to a decade. So like 1980s decade, the compounding was 21%, next decade 14%, then 17%. But now this 2010 to 20 decade was an outlier where you didn't even get 9% compounding, and that doesn't quite capture it. If you had put in 100 rupees at the beginning of the decade, at the end you would get 230 rupees, whereas in fixed deposits you would have got nearly 200. Right. Whereas in 1980, if you had put 100 rupees in 10 years, you would have got 700. So that's the difference, and that is that, like that below par return for 10 years is what created the room for this bull run you have seen since the COVID lows. So, but you are still not way above the trend line. This risk of a sustained crash is when you are way above the trend line, which has not happened. However, now if you look at the small cap side, and this is not something I am saying after the market has come down. People who have been following me know that I have been warning about this for months and quarters. I mean, there was a very clear post that I reposted recently on my Twitter in July last year. I said, no if, then, but this is the risk in small caps. Please get out and get into a steadier portfolio. It was not like, agar ye ho gaya, to ye hoga. It was not like that. It was very clear. And again, you talked about history. Now, this is the history of small caps. Again, people are new. They don't know the history. In 2008-9, the small cap index made a high. From there, it corrected nearly 80%. And that level of index came back after 8 years in 2016. And this is also theoretical that the index came back, because by that time the index had changed almost completely. So the stocks that fell never came back. Now this is the risk in small cap, micro cap, that some stocks of every bull run will never come back. They disappear into the blue yonder. Okay. So that's the thing. And then, you had another mad bull run 2017-18, another 2/3 correction. So, that's the nature of the beast. That's the nature of small caps, that they are high risk segments. And so you have to be super careful. So that's the whole point. And many stocks just disappear. I mean, don't forget.
Understood. Since you're constantly talking about steadier portfolio, you're warning about small caps, I just want to go into much more detail as far as steadier portfolio is concerned. Just for the knowledge of our viewers, right. When you're mentioning steadier portfolio, what does this mean?
So this means, I mean, broadly the large cap companies with a longer history, I mean, I'm not saying every large cap will be a buy, but I'm saying that's broadly the category you should be focusing on. Right. Large cap, and also some of the what you call mid caps are also fairly large cap if you go by the SEBI definition, because SEBI now longer gives it as market cap, this thing. So, I mean, I'm saying broadly the bigger companies are also, as it happens, cheaper today, right, compared to some of the smaller companies.
Right. Also, we know that you are someone who in your book extensively talked about and asked investors not to follow the investment strategy of Warren Buffett, Benjamin Graham and all other renowned investors as well. So what explains your argument that you are asking people not to follow the investment strategy of Warren Buffett? Young investors look up to him, they read his books. So why are you...
So you should read his books. I'm not saying don't read his books. Read his books, read everyone's books. And many people with very different strategies have made money. I mean, if you look at George Soros or Jim Simons, their strategy is very different from Warren Buffett. But I mean, of course, I have gone into great detail in all of these, but to very, very briefly talk about it. One, they may not be doing what you think they are doing. So, for example, Warren Buffett, everybody thinks he buys and forgets. But no, I mean, if you look at the actual data, he sells 85% of what he buys within 2 years, and the majority within 6 months itself. The second part is, how is the performance? Now, I'm not talking that Warren Buffett is the worst performing fund. I'm just saying he's well known. So, he has also underperformed the S&P 500 for 20 long years. But you mentioned Ray Dalio, his performance has been a disaster. disaster. I mean, performance compared to S&P has been a complete disaster. Warren Buffett has underperformed slightly, but Ray Dalio has been a disaster. But just because you can talk well doesn't necessarily mean that your performance is good. But there's an even more fundamental thing. The question you should really ask is that of all the people who followed a certain strategy, what has been the result? Not that if someone has become rich or successful as an investor or a fund manager, work backwards and say that if I follow that strategy, I will win. Because somebody might have followed a very high risk strategy, and sometimes they're high risk strategy with high payoffs where 90% of the people go out of business, but the 10% who remain make bumper returns, but that doesn't mean it's a good strategy. So are you asking the right question in the first place by saying, I will follow what rich or successful people have done?
So you talked about Warren Buffett. You also mentioned about Benjamin Graham and his investment strategy, and you also said in the book that you should not follow the investment strategy or what Mr. Graham was following.
I've not said that you should not follow. I mean, please read everything, but weigh it against what your experience is, and whether sometimes it is also that something may have worked at a certain point in time in a certain market, but doesn't necessarily mean that it will work for all time. And sometimes people don't even really read. So I mean, Ben Graham, everybody thinks they know or think they know what value investing is, because Ben Graham is the patron saint of value investing, and people think it means buying stocks with low price to book. But no, I mean, if you look at the last edition of his book, he talks about that now a lot of value is in intangibles, and this is writing 50 years ago, a brand or technology, and now that's even more so. But the most interesting thing is, again, looking at data, that he made most of his money in an insurance company, not in the value stocks which he talks about. So always, of course, read, but don't swallow anything whole. I mean, not what I am saying, not what the most successful person in the world is saying. I mean, always test it against what the real world data is. And as I said, sometimes something might have worked, like Peter Lynch is another favorite of people. Now, he talks about buying what you understand, which is basically consumer brands. The consumer brands worked well in 1980s and to an extent 1990s US. Doesn't mean that for all time in all markets consumer brands are the best things to buy. And the smart thing that Peter Lynch did was that he retired after 14 years of a great run in the fund. He recognized that that performance was not replicable. It was a particular place in a particular time, and he retired in his mid 40s. I give him a lot of credit for that.
Right. There is a very interesting story that you mentioned in the book about the Warren Buffett's Coke story versus PepsiCo story, right? Can you just throw light on that?
So, I mean, that was an illustration of storification. So, human beings are creatures of the story. I mean, we like stories rather than data. We remember stories, we teach through stories. So, if you look at even advertisements, the successful advertisements are the ones which have stories. So, if I tell you that 5 lakh children in this district are malnourished, you will turn the page. But I give the picture or a video of a single family which is starving, and you will give money to that charity. So, similarly, I mean, and the problem, real problem with stories also is that if you tell it often enough, the storyteller also becomes convinced. And that is to an extent what happened with Warren Buffett. I mean, this is only an illustration. I'm not saying that anything wrong with him as such, but the point is he told this story of that this is the stock, kind of stock to buy, that good brand, predictable cash flows, and Coke was the #1 brand in the world. I mean, no doubt about it. But the point is that because he told that story too many times, he became invested in it, and he never got out. So if you look at it over 30 years, Coke went up something like 13 times in a time when the S&P itself went up 18 times, Pepsi went up 25, 30 times. So it was actually a big underperformer, but by telling that story again and again, you become invested in that narrative. So it was an illustration to show that you should look at data rather than narratives or stories.
Right. One statement that I have come across that you have repeatedly talked about is a frothy space in the equity market, and you have suggested investors to stay away from the space and rather book profit and exit. If you look at the current market, stock market, Indian equity market, what according to you are those frothy space that investors should come out of or should exit?
Of course, many of them have already come down a lot. So I say an easy way to find out where there is froth in the market is look at where the new fund offerings are coming, where the new thematic schemes are coming. So whether it is small cap, whether it's defense, whether it's PSU, or at another time there was NASDAQ in 2021, or even further back in 2000 there was the tech funds. So every time if you see, this is a pattern that when the thematic funds are launched, that's normally when that theme has matured and is close to the peak. It's more likely to fall rather than rise from there. And the reason why people invest in that is FOMO, fear of missing out, that by the time you have understood the scheme, or rather the theme, it is already little late in the day. So in general, avoid new fund offerings of thematic funds. And that is also a indicator of where there is usually froth in the market. And of course, then there are like IPO hype hoga, there will be micro caps, there will be various other kinds of things. So I mean, don't try to get too exotic in the market.
Right. Yeah. Also, I know I want to ask you about the correction. Some people are saying that it's a cyclical slowdown that market is grappling with. Some people are saying that worst is behind us. Some people are already the market have corrected by 12%. What is your sense? Do you feel that it's a cyclical slowdown, or do you feel that the correction is going to stay on for a longer period of time? And if you feel that the correction is going to stay on, then how much the market is going to correct more?
It is very difficult to say that. I am no oracle to say exactly how much, but I would think for the larger caps, the downside is now limited. Might be another 4-5%, I would think. But as I said, in small cap, micro cap, many stocks never come back. The stocks that go up in one bull run sometimes never come back. So be cognizant of that fact. Or for that matter, many of these IPOs that have come, we've had IPOs in the past where that stock price was never reached. I mean, let alone complete disasters like Reliance Power, which was such a coveted IPO. DLF did not come back to its IPO price for decades. So that is the issue, that whenever there is too much hype around something, you might never see those prices again.
Right. Do you see, you said that you expect markets to correct even 5 to 6% further. What are the triggers as per you for those correction going forward? Because we are seeing a lot of volatile triggers, volatile environment, tariffs are being imposed, reciprocal tariffs, macroeconomic fundamentals. What are the triggers that you foresee for this correction to happen going forward?
Rajat, the thing is this, the narratives always follow what happens in the market. So it is, for example, last 3-4 months, people are talking of consumption slowdown, and that's affecting the markets. But if you look at the data, the consumption slowdown happened in the previous financial year. In 23-24, the consumption growth in India was at a 21-year low. This year, it is actually accelerating.
Picking up.
But because the market fell, now suddenly everybody wants one theory, so they've gone back to consumption. I was talking about consumption last year. I said this is like a 21-year low in consumption. So, stories always follow the data, and the markets have a mind of their own. So it's not, I mean, it's not as if that for the same data, depending on whether the market goes up or down, you can find a story. Like for example, if let's say you're looking at the US, if interest rates are not cut and the market falls, you will say obviously interest rates had to fall, and only then the market would have rallied. But if they are not cut, you can also say they are not being cut because the economy is doing so well. So therefore, there is a logic for market to go up. So either way, you can come up with this logic.
Right. And also in your book, you have said that investing is a loser's game.
Right.
Why? Can you just explain that why you are saying that investing is a loser's game?
Okay, so this is a very eye-opening article, I would say. It's a 1970s article, The Loser's Game by Charles Ellis. I mean, so all of you should Google it, and it's only a 4-5 page article, and it's a mind-opening article because it said everything in the world is a winner's game or a loser's game, and games change character. So, for example, aviation. At the time that JRD Tata was flying from Karachi to London, it was a winner's game. It was an adventure sport because some part didn't work, he wound some wire and made it work, he didn't even land, he missed one town altogether, he landed in some disused airstrip and all that. But now there's only one way to fly an aircraft, go by the checklist, don't make mistakes. So in our grandparents' time, maybe investing was a winner's game because information was not available, even annual reports were difficult to get, there was no Excel sheet. So getting information was the edge. you could find gems which were not known in the market in a sense. Now all data is available to everybody. The best minds are in the market. So your first aim has to be not to lose. You will win if you don't lose. Don't lose doesn't mean, I mean, you should have strict stop losses. So take the small losses so that you don't take a crippling blow on your portfolio. So don't lose big money. That's the mantra. That's the first mantra. Okay. So, and if you do that, you will win. I mean, if you look at mutual funds, for example, the best performing schemes are the ones which perform in downturns, which outperform in downturns. There was one scheme which which outperformed almost all the upturns, but it was almost the bottom performing scheme, because when the markets fell, it fell more.
Right. Also coming to another discussion, there is a lot of chatter around that also. Since the market are witnessing downturn, people are saying that you should exit SIPs if you are investing in mid cap or small cap funds. What is your sense? Should we exit the SIPs right now?
In general, it doesn't make sense to exit SIPs. But if you were doing it in a narrow theme, I mean, don't have SIPs in general ever in a narrow theme. So don't have it in a industry fund, don't have it in only small cap fund. So always be in a broad based fund. And one of the reasons is that the main value that a fund manager adds is whether you should be in small cap or large cap, whether you should be in IT today or whether you should be in defense. If I am leaving it to you as a lay investor, you don't have the skill or the information to do that correctly. And anyway, that is what you are paying the fund manager for, because 80-90% of your returns come from there. So be in a broad based fund, but it's always a bad idea to quit when the market has fallen. I mean, that's never a good idea, because as I said, that's where you will miss out on the upturn. That those 10 best days have never come in a bull run. They always come when there is fear and uncertainty in the market, not when people are happy and secure. Always in market returns, and this is data across the world, there are many research papers on that, from Portugal to Brazil to the US, that sentiment is a contraindicator. When everybody is happy and gung-ho, the next period returns are below normal, and when everybody is scared and uncertain, the next period returns are above normal. So always at the, after the market has corrected, there's definitely no case to be made to quit SIPs. As I said, the problem was last year a lot of people went out of their large cap SIPs and went into small cap SIPs, which was the wrong thing to do. Right. So,
also, one thing that I have observed in your book, and I was reading through all the articles and the tweets, you're discouraging people to invest in small caps, and you have been cautioning them not to invest in small cap rather than go for a large cap. So what do you feel, if a young investor is going forward in investing, they should never touch small cap, and what is the reason behind it?
No, it's not that you should never touch. I said you should look at the whole basket, and the main value a fund manager adds is when you should be in which segment. So for example, for our PMS, normally, I mean, I'm not talking the SEBI definition of small cap, but we look at the risky small caps as something below 5,000 crore market capitalization. We don't look at anything below 1,000. So the 1 to 5,000 crore is where we manage it. Normally, we will have 13 to maybe 15% of our PMS in that. At times, we've even gone up to 22%. But last 1 year, we have been in the 5 to 7% range, even though, I mean, we could see the momentum and we knew that it would hurt relative performance in the short run. But as you said, investing is a loser's game. So our first focus is always not to lose big money. And in small caps, some of the risk management measures don't work. For example, I always say have a stop loss. But the point is, some of these stocks, when they fall like a stone. It's like circuit down every day, there is no exit. So that's why and you can't hedge them, because the only hedge available is a put on the Nifty, which doesn't move along with the small caps. So you have to calibrate that risk, and that's why I'm saying that your fund manager or your financial advisor should have the skill to do that. You will not have that skill if you are a lay investor.
Let's talk about a lay investor, because that's what people are seeking knowledge on. If a young investor with a corpus of 20,000 rupees wants to start in a stock market, in an equity market, where should he go? And he doesn't have access to fund manager or something like that. So what should be the investment?
So be in a broad-based mutual fund. So start with that. And often people ask me that I can't save 20% of my salary, so what should I do? I said, you start with 5% of your salary, but next year's increment, put 70% of your increment into your investment basket. That's the way to do it. Because otherwise there will be only lifestyle inflation and you will spend it all. So make that conscious thing that that money goes out and starts getting invested, and don't wait to optimize everything. But even if you are in a reasonable area, don't be at either end of the risk spectrum. Again, I see people sometimes go from fixed deposit right to saying I will become a day trader or derivatives or crypto trading or something like that. So don't do that kind of stuff with your hard-earned money.
Okay. Also, I want to ask you, you also said that there is no risk of a sustained market crash.
Right.
Why do you feel so? Because some investors are jittery. They want to know, is this downfall going to stay on? What is the future of the money that they have invested? So, but you have said that there is no risk of a sustained market crash.
Yeah, and that was what I spoke about, that 2010 to 20, that decade, the return was so much below normal. That is what has created the room. So the risk of a big crash is when you are way above the trend line. You're not even at the trend line of that 15-16% return. So that's why I'm saying that for the mainstream indices, I don't see a big risk, which doesn't mean that, in the market, sometimes there are long periods when things don't go well. I mean, there was this book on Rakesh Jhunjhunwala, and the authors had not focused on that line. But for me, the gist of that book was that one line where Rakesh says that I made a lot of money from, I think, 89 to 92, from 2003 to 2007, and one more period. He said these 3 periods I made a lot of money. In between, there were even 5 years where I made no money. So I said his superpower was not identifying the stocks. His superpower was understanding that equity market returns are lumpy. And sometimes, 7-year returns will come in 2 years, and 5 years you will see nothing. So that is the mindset you have to cultivate. So don't put money in equity unless you will not touch it for 8 to 10 years, which doesn't mean it should be in the same stocks for 8 to 10 years. But in the markets, they should be there for at least that much time, and that's one of the reasons why you should not have 100% in equity, because there are always sometimes, some reason or the other, you might need money, you might be buying a house, you might lose your job, you might want to study further, whatever. So don't have 100% in equity, but whatever is your equity allocation should be money you don't need for at least 8-10 years. Okay. And also look beyond India. That's the other part.
Okay. Since you talked about Rakesh Jhunjhunwala, let me just discuss that, because he's called as the Warren Buffett of India, and you are someone who is saying not to follow the investment strategy of Warren Buffett. So what sets Mr. Jhunjhunwala apart from Warren Buffett, and how do you see his investment strategy?
So that's the thing. See, I mean, people think that he had some, that stock picking was his big skill. But if you met Rakesh over the years, and he was somebody well known to me, he would be talking about a different stock every time you met him. So he did not know in the beginning that these 3-4 stocks, Titan, Crisil, Lupin, and a couple of others would make him all his money. So that's the takeaway, that no one knows in advance which are going to be the multi-bagger. Sometimes people ask me that your big calls are, HDFC Bank in 1996 just out of the IPO, or Amazon in 2001 when everybody had a sell on it, we had a strong buy. And which is the next HDFC Bank or Amazon? I said, anyone who tells you that they have this superpower of identifying multi-baggers is telling you a lie, because no investor in the world has ever had a portfolio which, let alone 100% multi-baggers, is even 50% multi-baggers. At the most, when you are recommending a stock, at the most you can know कि ठीक है, double हो जाएगा, triple हो जाएगा. Beyond that, you do not have any crystal ball. Aditya Puri and Jeff Bezos also did not know that this would be the 20-year trajectory of our company. So this is all nonsense. So you have to choose a portfolio of at least 25-30 stocks with a system, and out of that also 5-7 will be duds. Some will give you normal returns, and if you're lucky and you've chosen them well, you might get 2 or 3 multi-baggers, but you will not know in advance which those are. I just read a book on Tanishq, written by the CEO of Tanishq, and you know how many times that Tanishq business came close to being shut down. So it's not as if Rakesh had some superpower, he knew that Titan is going to be this great return. So no one knows in advance.
Then what made him a successful investor?
So a part of it is the luck of the draw. That's why I'm saying that never work backwards from there, that who is successful and what did they do.
So you talked about Rakesh Jhunjhunwala, but what made him so successful? You're saying that there is no no one knows what to pick up. It's just the luck that makes someone successful as far as stock market is concerned. So what made Mr. Jhunjhunwala so successful?
So investing is a game of skill and luck. So that, like most things in life, only chess is the game of skill alone. So anyone playing, I mean, when a large number of people play a game, there will always be at the end of it certain number of people who will succeed, which is why I'm saying never work backwards from there. Like Rakesh, for instance, made his initial capital in trading. Somebody asked him this also, that you made your capital in trading, why do you tell people not to trade? And he says it's like you might be a smoker, but you might still tell your child not to smoke. So it's not as if that it's a, of people who trade, very few are successful, but because it's a high risk game. But of somebody who's successful can make outsized return. So that is the thing. As I said, the one thing which struck me in that book was the fact that he knew that that equity investments can be, the returns can be that lumpy, and therefore he stayed the course. So that was definitely one thing. But always ask that of all the people who followed a certain strategy, how many were successful, rather than work backwards from that so and so was successful and what strategy did they use. Because a very high risk strategy, let us say you have a strategy where 90% of the people go bust in a year, but the 10% who are there make 10 times their money. After 5 years, there will be only 1 or 2 people left, but they would have made like tons of money. So doesn't mean that was a good strategy. So always remember that.
Right. Also, you also mentioned this point while you were talking that you never touch a small cap below the market cap of 5,000 crore. And that's also one of the risk management criteria that you have in your company. So when you go for investing, what are the 4-5 key things that you watch out for as a risk management strategy?
Risk management in particular, no, we do look at things below 5,000. We don't look at anything below 1,000 crore market cap. 1 and 5,000, we monitor that how much is our portfolio in that, and therefore, how much are we comfortable with at a certain point in time. So that's the strategy. But risk management, especially we do many things because we always focus on risk first. We always say 60% of your fees are for risk management and 40% is for return management, just to emphasize that risk is more important. But even as an individual investor, at least have a couple of things. One, have a stop loss, and what is called a trailing stop loss. Now, what is a trailing stop loss? Suppose you buy something at 50, our stock at 50 rupees, and you have let us say a 25% stop loss. So it doesn't mean that your stop loss gets fixed at 37.5. If it goes from 50 to 100, comes back to 90, you continue to hold. So don't have a target that if the stock doubles or triples, I will exit, because then you will not get the multi-baggers. With 100, say 150, you keep holding. 100 to 200, you keep holding. 200, when it comes down to 150, now it is 25% down from the high. Then you exit. That's what a stop loss means. So that's one simple thing. The other simple thing is always look at, people are sometimes not even aware what's in their portfolio. So look at your portfolio, make sure you don't have too much in a single sector. So let us say, even if you are holding 20 stocks, if out of that, 7 are banks and 6 are FMCG companies, and another 6 belong to one sector, let us say pharma or chemical, then you are effectively holding 3 stocks, because stocks in a sector tend to move together. So diversification is not just number of stocks, it's also sectoral diversification. So these are simple things that you can follow as an individual. As a fund, of course, we follow many other things as well.
Also, last 2 questions. One is about the price to earning ratio. In your book, you talked about that a higher emphasis on PE ratio is highly misplaced. And you talked about certain other parameters to watch out for when you're going for investing in a particular stock. Can you just explain it in a detail for our viewers?
Yes. So why is it that in the same industry, this is one of my interview questions, that something might trade at 20 times PE and something might trade at 40 times PE? And if you look at theoretically, the determinants are, one of course is growth in cash flows and earnings. And the other part is return on capital employed, or return on equity, and which has to be balanced with the cost of capital or cost of equity. Now, people will say many of these things are, you're making assumptions, but the point is, when you're saying that this is, for this company 25 P is justified, for that one 50 P is justified, then you are anyway implicitly making all these assumptions. So, be explicit about it, but more important is, most of us only look at the income statement, that this happened to the sales growth, this happened to the margins, this happened to the earnings growth. We do not look at the balance sheet, we do not look at the cash flows, and that is where things hide. For example, right. So those are things you can look at.
So you're trying to say cash flow is one of the most important parameters.
Yes, because what happens, for example, there's a slowdown in the business. Now, first of all, the management also knows that everyone will look at sales and earnings. So they will, how will they try to manage it? That they will try to push more into the market by giving more credit. So receivables will go up. And therefore, that will show up on cash flows, it will show up in receivable days, it will not immediately show up on the income statement or profit and loss account. So that's why it's important to look at all of that.
Right. The last question. We also know, I think 1 month back I interviewed Mark Mobius, and I was speaking at length about the market levels that he see going forward. So he said this year the Sensex is going to breach 1 lakh target. So I just want to ask you, there are two parts to this question. One is this level of 1 lakh, by when you expect that to be crossed? Second, by when do you feel that the markets are going to make a comeback and this correction is going to be over?
Okay, Rajat. So first of all, let me tell you that in my 30 years in the market, I have never ever given a 1 year Sensex or Nifty projection, not on New Year, not at Diwali time. And while I've never given it, I got the term for it a couple of years back when I read Daniel Kahneman's Noise, and the term is objective ignorance, which is things you not only don't know about, but you cannot know about. So to be confident about something you cannot know about is the biggest stupidity. And in relation to that, Bloomberg recently did a study, because in US you have this data of people's projections going back decades, and they found that on the average, the projection made, and this is all the big Wall Street firms, all the big banks in the world, HSBC and Citicorp and Morgan Stanley and Merrill Lynch, so that level, off by 15% points. So if they say that the S&P 500 will this year grow 20%, it can be 5%, it can be 35%, it can be anywhere. And most of the time, everyone projects a 0 to 10% increase in the S&P. And in the last 100 years, S&P has moved by 0 to 10% in a year only 14 times. So basically, all these projections are not worth the paper they are written on. Nobody has a clue on a 1 year basis, and anyone who's telling you, please look at their last 10 years projections and see what the reality is. So this is all complete nonsense, which is why I never ever give a 1 year projection. So,
right. So what about the correction? When do you feel that this correction is going to be over? And markets are going to make a comeback.
There's no formula to it, but I think, now we are in the range of somewhere bottoming out. I said, which doesn't mean that it can't go down by another 4-5%. But I mean, we are in the range of where you should be getting in. So if you were sitting outside saying, I will get in when there is a correction, are you getting in now? I mean, that's my question.
Thank you, Devina, for talking to us. And I think it would be a wonderful, knowledgeable session for the investors who are watching out for the information as far as investing is concerned. Thank you for sparing time out and speaking to Republic Media Network.
Thank you. Thanks for having me.